Welcome. I'm Jim Jackson. I'm here with my colleague Kevin Kaase, and this is our first installment of Bonding Over Bonds, our periodic review of all the comings and goings in the U.S. fixed income market. Last week we saw positive returns in fixed income. The Bloomberg Barclays U.S. aggregate had a positive return driven by the decline in Treasury rates. So week over week, what we saw is the 10-year Treasury yield declined almost 7 basis points so that it sits currently at 1.57%. Credit spreads, which is the other component of returns in the Bloomberg Barclays Ags, were relatively flat. Credit spreads are the additional compensation you receive above Treasury bonds for taking credit risk. So what were the big news items driving fixed income markets last week? Well, first I would say at the end of last week, the GDP print was the strongest that we have seen in almost 40 years. So strong economic growth. That is leading to strong corporate earnings. So as of April 30th, approximately 60% of the S&P 500 has reported earnings. According to FactSet, of those that have reported, 86% have beat earnings estimates, and that beat averaged almost 23%. So if those trends continue, the rate of earnings beat will be the strongest it has been since FactSet started recording this data in 2008, and the magnitude of the beat will be the second strongest that it has been since FactSet started reporting this data in 2008. Finally, we continue to see improvement in the employment environment. So to sum it up, the three things we're seeing: strong economic growth, strong corporate earnings, and a drastically improving economic employment picture. So what does that mean for fixed income? Well, I'll turn that over to my colleague, Kevin Kaase.
Thank you, Jim. Even with all the good news in the macro environment, most has already been priced into the market. Well, it's been a rather quiet start to the month. Trading volumes this week have been relatively muted. According to Trace, which is trade reporting and compliance engine, trading flows have been down week over week. The credit markets have moved higher, and the credit spreads have held in with little movement despite equity volatility. The new issue calendar has been lighter with approximately $23 billion in new issuance to start the month. This is important because new issuance typically generates more market activity and helps to create liquidity in the marketplace. Next week, we expect new issuance to start to pick up. We are expecting 30 to 35 billion for the week and 150 billion for the month. Overall, there appears to be plenty of pent-up demand and money in the system to put to work. We have seen continued demand for bonds out of most asset managers, pension funds, and insurance companies.
Great, Kevin. Thank you. Great insights. So that concludes our first installment of Bonding Over Bonds. Please join us next time.